Warren Buffett is accumulating a significant amount of cash. In fact, he has amassed enough money to fully buy companies like Disney, Nike, IBM, Philip Morris, or Starbucks. To put it another way, Warren Buffett could easily purchase any publicly traded company outside the top 70 in the world without resorting to debt or leverage. But why is the greatest investor of all time accumulating this record amount of cash? Is he seeing something in the market that is being indifferent to others? Today, I will tell you about Warren Buffett's investment philosophy and why it is not surprising that in the market and with the current economy, his primary investment strategy is precisely not to invest. Berkshire Hathaway is the investment vehicle of Warren Buffett, and it is where he has virtually concentrated his entire portfolio. Buffett has been directing Berkshire, along with his right-hand man Charlie Munger, since 1970, and it currently stands as the 8th largest company by market value in the world. Berkshire's revenues come in two types. Firstly, operational revenues, primarily comprising the earnings from hundreds of privately owned businesses controlled by Berkshire, which Buffett and his partner have acquired over the years. Examples include Burlington Northern Santa Fe, Nebraska Furniture Mart, Fruit of the Loom, and Geico. Secondly, portfolio revenues, where the appreciation of stocks and dividends from Berkshire's investment portfolio in publicly traded companies, over which they do not have complete control, are recorded. Much of Berkshire's success is attributed to managing the cash flows generated by its various businesses. Buffett has consistently redistributed these funds, always seeking the best possible return either within the company's existing businesses or in new investments. For instance, a business like See's Candy, requiring low reinvestment, has served as a cash generator to gradually acquire other businesses many times its size, such as Coca-Cola or Apple. This seemingly straightforward and obvious strategy is crucial to mention in this context because, unlike a typical investor limited to publicly traded companies, Warren has the option to invest in hundreds of private businesses and numerous projects of all kinds. Therefore, when it was revealed in Berkshire Hathaway's quarterly earnings report last week that Warren Buffett had accumulated over $150 billion in cash and short-term debt, investments set to convert into cash in the coming months, many analysts concluded that Buffett has not identified attractive investment opportunities in the current market and economic situation. For this reason, he has accumulated a record amount of cash for his company. To better understand why Buffett finds nothing appealing in the current market, it is necessary to delve into his investment philosophy. Warren Buffett is constantly looking for deals or projects big enough to be relevant to Berkshire. These investments must comply with something key to his philosophy, that they can be acquired at a fair price. Because no matter how good a company is, no one deserves to pay too much for it, because if this is done consistently over time, the result will be extremely poor or negative. Furthermore, Warren Buffett avoids attempting to predict the short-term market and instead focuses on long-term economic trends. This approach includes steering clear of predicting potential crises or any form of market timing, whether it involves setbacks, rebounds.
I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know.
Despite Buffett's cautious stance and statements regarding such situations, possibly due to an understanding of the panic his words might induce given his status, his actions ultimately reveal a significant insight into his market and economic outlook. While not aimed at predicting a crisis, his moves are indicative of his ability to identify adverse conditions for investments, as seen in his responses to various bubbles throughout the years. One of the most commonly used methods for valuing stocks in a market is through multiples valuation, where the relationship between earnings, sales, and book value is examined in relation to price and similar metrics. While this method can provide a generalized guide to how overvalued or undervalued the market may be, it is only a superficial guide and is not the primary method used by Warren Buffett.
because everything in valuation gets back to interest rates. And if you take the U.S. Treasury bill now, which is, we'll call it 80 basis points, depends what maturity, that means the U.S. Treasury bill is selling at 125 times earnings. Now, if your alternative is to buy something at 125 times earnings, or a good business whose earnings will probably increase at 15 or 18 times earnings, you've got to measure it against the risk. It isn't really a risk-free instrument, but the standard rate. And in 1982, the rates got up 15% or thereabouts, and that makes a lot of difference. I mean, you've got a choice with money. What do you do with it?
For Buffett, prices can be considered high or low depending on interest rates. Interest rates act as gravity for stock prices, and when interest rates are low, high prices are justified, whereas high interest rates make high prices more irrational. A better way to understand this is by looking at investments in terms of opportunity cost rather than absolute terms. If an investment can yield a return of 5%, for example, this is not inherently high or low. It depends on other market options. Dozens of options with potential returns above 5% would indicate that this is not a good choice, whereas if other investments have potential returns around 2%, this would suggest it is a good investment. Warren Buffett uses long-term U.S. Treasury bonds as a reference for this, and with these bonds yielding around 5% annually, an investment in stocks or projects that offer a similar expected return is clearly a poor investment now that the opportunity cost has become much higher compared to when interest rates were low. It is precisely in this scenario of high rates and relatively high prices where Warren Buffett has identified that the possible investments he can make are not attractive, and for this reason he prefers to accumulate cash before investing against the principles that have led to his remarkable success. So based on everything we know about Warren Buffett's investment philosophy and the way his company Berkshire Hathaway operates, it is clear that he is not predicting a crisis and accumulating cash for that reason. However, he is indeed identifying elevated prices that have led him to seek refuge in cash and equivalents, likely awaiting good opportunities that could potentially involve the bursting of a bubble. Because despite the economic changes compared to 2021, such as the increase in interest rates and the reduction of money in circulation in the economy, stock prices still remain near historic highs, an evaluation that is difficult to justify. Nevertheless, until a triggering event occurs, this correction may not materialize. The catalyst could come from the government being compelled to reduce spending to address its deficit and control debt, from consumers depleting their savings and struggling to manage their credit card debt, or from investors themselves opting for bond investments over stocks. What do you think Warren Buffett sees in the market? I would like to hear your opinion. And if you haven't yet seen the biography of this great investor, I recommend you checking it out next.